All right, I have 11:02 and we still have people joining, but to be respectful of everyone's time, I'm going to get started. It's my pleasure today to introduce Stephen Rick, who is a director and chief economist for Q Mutual Group in Madison, Wisconsin. His primary responsibilities include conducting strategic research, analysis, in the trending of the financial services industry with a special emphasis on the consumer and credit union markets. Steve's forecasts serve as a starting point for the strategic planning process and help to create a clear understanding of the underlying trends and links between the general economy and the financial services industry in Q Mutual Group's policyholders. We are fortunate enough today to have Steve share some of his insights with us. Welcome, Steve, and the floor is yours.
All right, well, thank you, Dean, and good morning, everybody. Yeah, we'll take a look at this economy and where it may be headed basically for the next year or two. As we know, the Federal Reserve is meeting in Washington, D.C. right now, and they'll be looking at the same charts that we'll be looking at today, and we'll find out in about 3 hours here what the Federal Reserve is going to do with interest rates. You know, are they going to move interest rates up 75 basis points or 3/4 of 1 percentage point, or will they go 100 basis points? Well, basically, the decision is going to be based on these charts that we'll be looking at. So let's jump right in, basically answer the first question. Are we in a recession? Are we not in a recession? If you'll notice here, my first chart looks at U.S. economic growth. In my chart, notice I have some red bars. Those red bars indicate recessions. And hopefully we don't have a recession in our future. And here's our forecast. We're forecasting about a 1% growth this year. Now that's going to be a little bit weak. When I can use the word weak, you may be saying, what are you talking about? Well, you see the gold line on my chart? You know, economists should always have gold lines on their chart. That's where we should be growing. That's normal, or what we could say organic growth rate. So we're not going to be growing that this year, a little bit below that. And next year, we're forecasting 1.5%. So once again, weak growth. So if you want to use the word recession, call this a growth recession. Now, the economy is growing, we're producing more goods and services, which is good, but we're not doing it at the normal pace of 2%, my gold line on the chart. So a little bit weak here. And so what are some of the takeaways from this? Well, basically, we are forecasting that we'll have this growth recession with about a 50% probability. That's our base case. That's what we expect. We could, of course, have a recession. What could cause that? Well, we're forecasting Europe to be struggling this winter. We're actually forecasting Germany to have a recession next year of about minus 3.5%, France to shrink maybe 2.5%. And you know, Europe's one of our major trading partners. So if they're in recession, their income is going to be down and they won't be buying as many as our exports. So that will weigh on the US economy. That is a big risk that could cause a recession. You know, what's going to happen with their gas supplies this winter? If it's going to be a cold winter, what's going to happen to their industries? So we are forecasting Europe is going into recession. Hopefully we can skirt that and not have our own recession. And then I got a 20% probability on my little list there. We could just have a soft landing, that we could get close to that 2% line. Like I said, that's a really small probability. We don't think that will happen. But we have some good news out there. American balance sheets are still strong. A lot of Americans have a lot of deposits still from all that stimulus check money. The labor market is strong. Job growth is still over 300,000 a month. So we've got a lot of good factors in that. Hopefully we can keep this economy rolling, but at a little bit slower pace than normal. Moving on to my next slide, but you may say, but wait a minute, Steve, I heard on the news that we had 2 consecutive quarters of negative growth. And you can see by my chart here, that's true. In the first quarter of 2022, the second quarter, as you can see in my data, we did have negative growth. We produced less goods and services. But we want to be clear here, negative growth is only a necessary condition for a recession. It is not a sufficient condition. There's about 4 other variables that the National Bureau of Economic Research looks at in order to determine a recession. And one of those, of course, is job growth. If we started losing jobs in this country instead of adding 300, then we'd be more closer to a recession. So this is not a recession. Like I said, this is only a necessary condition, not a sufficient condition for a recession. And basically, what explains those negative bars? Well, if you want to use the word recession, what we had in the first half of this year was an inventory correction recession. Basically, firms were still adding to their inventories to replenish their inventory stock. Think of Target or Walmart. They were still adding stuff to their back room and their stock, but they were adding it at a slower pace. Now, how can I say that? Well, notice I've added little blue bars to my chart. The blue line is the inventory contribution to the big swings in our economy recently. Notice in the fourth quarter of last year, that big blue bar shows that most of the growth in the economy was just due to massive inventory accumulation by, say, Target, Walmart, and all these other places. But then in the second quarter of this year, notice, once again, they were still, I want to be clear here, they were still adding to their inventories, but it was at a slower pace. And that can actually slow the economy down, which it did. Final sales to you and me were still positive, but it's just an inventory correction taking place. And we believe in the second half of the year, both of these bars will be positive again. Now, jumping into the big question that a lot of people are talking about, I can kind of summarize my whole presentation with a quote from a famous author. What author am I talking about? Charles Dickens. As you all know, Charles Dickens wrote that book, A Tale of Two Cities. And the most famous line in that book is the following: it was the best of times, it was the worst of times. And that one phrase can apply not only to the economy, but also to credit unions. We've had the best of times and the worst of times this year. Well, what are we talking about the worst of times? Well, this has to do with inflation. And let me just put it into a poem form. That inflation or deflation, tell me if you can. Will we be Zimbabwe or will we be Japan? Zimbabwe is a country in Africa that about 12 years ago was running 1 billion% inflation. That's right, I said billion. Where Japan is on the other end of the spectrum. They've had zero inflation for the last basically 30 years. So hopefully the United States will fall somewhere between these two countries. And here's the actual data. We're currently running inflation, right around that 8% range. You can see that blue line. So inflation skyrocketed in the last year, way above our target there. Remember I said economists should have gold lines on their chart? That's where the data wants to be. That's where it's naturally going to be. Where 2.5% is kind of our natural target for the CPI measure of inflation. It's way higher than the Fed would like. And the number one goal of the Federal Reserve, like I said, in Washington, D.C. right now, the Fed is looking at this chart. And they are not happy that we are at 8.5%. So what they're going to do is raise interest rates. So credit unions and banks raise our interest rates, and that will slow down lending. And as lending slows down, people will be buying less, cars and motorcycles and trips or whatever. That's how they slow down the economy. They kind of work on the demand side, the buying side of the economy. And hopefully we are going to turn the corner here and bring this down. Now, what the Federal Reserve is also talking about right now in Washington, D.C., is they're worried about something called inflation expectations. What do people expect inflation to be each year going forward? If they expect high inflation, they'll demand higher wages, they'll build in faster price increases in their products. We don't want that to happen. We don't want people to think we're going to be having this 8% inflation for the next 5-10 years. Well, are inflation expectations going up? Well, let me jump to my next chart here. Notice I've changed my gold line to what we call the basically 10-year break-even inflation rate, where this is basically saying the market, the bond market, Wall Street, New York City, all those bond traders, they basically believe inflation for the next 10 years is going to average about 2.5, which is really right around their long run average. So fortunately, the Fed is happy that this gold line or inflation expectations are still at 2.5%. It hasn't jumped to the blue line to match actual inflation. That expectations are still low. So this is keeping the Fed somewhat happy, but they are going to have to keep raising rates to bring down that blue line. There are a lot of factors, of course, pushing inflation up, but I've just listed some of the factors here. One, we did have a lot of pent-up demand for goods and services. One definition of inflation is too many dollars chasing too few goods. Well, we had a lot of too many dollars part where we had a lot of lending taking place with low interest rates. Plus, we had a lot of stimulus check money going up. So there's the too many dollars part. The too few goods part of that statement is number 2 on my list. We did have a lot of supply chain disruptions, reducing inventories. And when I say reducing inventories, just to give you a number on that, if you went to a typical new auto dealer today, say you went to your local Cadillac dealership, and you look at how many cars they have on the lot, they're only about 25% of normal inventory. So say if they normally had 100 cars, they only have 25 cars today. So they are trying to rebuild their inventories, but they just don't have a lot to sell. And that is kind of hurting sales a little bit here in the United States. And of course, we have rising energy, commodity prices, but a lot of those have turned. If you've seen recently, oil prices have come down from $125 a barrel down to around $80 a barrel today. So basically, it has turned around, and we are seeing some good news on this. But of course, in any debate, you have to have the other side of the debate, and there are some inflation factors lowering the inflation rate. And of course, the big one is e-commerce, one of the most powerful deflationary forces the United States has ever seen. It's really hard for one of your local retailers on Main Street to raise the price of what they sell without losing market share to Amazon or some other online retailer. So we have these factors kind of offsetting each other, and basically we believe the following is going to happen in the next couple of years. Here's our forecast for the United States CPI inflation. This will be the worst year. Remember I said Charles Dickens, the best of times, the worst of times. This is the highest inflation in 40 years. So this is the worst inflation, the worst of times that any of us have seen in our working careers. You go back 40 years, there's not too many of us who've been working for 40 years, but basically 7.7 this year. But the good news is we are forecasting it to come down to about 3.5% next year. So about half of what it is this year. So price level will still be high and rising, but the growth rate of the price level will slow. And then by those out years of 2024, 2025, we'll come back down to that 2.5%, because that's where the economy wants to be. Remember, that's kind of like the organic, natural inflation rate. So here it's kind of like, if you use another analogy of an airplane landing on a tarmac, you kind of want that airplane to land nice and gently on the tarmac, have what's called that soft landing. Well, here's a picture of what the Fed would like to see of inflation coming down, hitting that gold line or our tarmac of the airplane analogy, and being about 2.5%. Now, what are the takeaways for this for, say, the credit union industry? Well, one, this high inflation is causing a lot of household financial stress. Some of our low-income members are having a hard time paying for the groceries and gas and rent. And so that means there's less money available to maybe make that credit card payment on time or that auto loan payment on time, which point number 2 on my list is going to push up loan delinquency rates with some of our low income members. Even though the overall delinquency rate is still very low today, some of our low income members are having little problems with their making payments on time. Number 3 on my list is what the Fed is doing today in Washington, D.C. They will be raising interest rates, probably, like I said, by 75 basis points. Number 4, labor costs. As we know with credit unions and a lot of other businesses, about 60% or so of our total operating expenses are just labor costs. And basically, a lot of credit unions are making wage gains this year, or say the raise they're paying their employees of around 5-6% because of that tight labor market. Now, that's not really good. That kind of feeds into what we call a cost push inflation, where, say, labor costs go up, so firms got to raise the price of their product in order to keep their profit margins. And so labor costs are rising around 5-6%, and that kind of keeps inflation going. And that's where we're worried about these inflation expectations feeding into basically higher inflation. So labor costs are going up. We need wages to be going up around 3% in order to have a 2% inflation. So 3% raise would tie into a 2% normal inflation rate. And then number 5 on my list, just overall operating expenses are going up. Set aside labor costs, everything else we need to, say, run a branch is also going up. All this is pushing down credit unions' net income this year as operating expenses go up. All right, this was the worst of times chart, the high inflation. What's the best of times? Well, that's this chart right here. Here it is, the unemployment rate. That's my aqua colored area on my chart. And you can see we're about 3.7 today. During the summer, we actually hit 3.5%, which was the lowest in 50 years. So this is a great labor market for employees, workers in this country. So here's my best of times chart. Where should we be on the unemployment situation? Well, notice I got my gold line in there again. That's where we should be, about 4.5% unemployment rate. That's the natural, organic unemployment rate. So we're below that. So we do have a tight labor market. And just to show you how tight it is, right now in this country, we have about 11 million job openings. You know, vacant jobs just sitting there. You know, credit unions trying to hire tellers or loan officers. You know, manufacturers looking for welders, whatever. 11 million job openings. How many unemployed people are out there? You know, what's the labor supply, if you will? Only 5 million. So you got 11 million jobs with only 5 million people available to fill them. So we have a big imbalance. You know, economists like to use that word imbalance. We have an imbalance in our labor market. We got to bring more imbalance, bring down that 11 million number and bring up the labor supply number and try to get those back into balance going forward. Well, how are we going to do that? Well, the Federal Reserve is raising interest rates to try to get firms to lower their demand for labor from 11 million, say back down to 6, 7, 8 million. And we're trying to get the labor supply up. We're trying to get more people back into the labor market. And we are seeing that. You know, we lost about 5 million people because of COVID. You know, people left the labor market. They actually quit because they're worried about their health and maybe had some underlying health condition. But those people are coming back now that we have vaccinations and all that. Also, we had people leave because of, say, childcare issues. They couldn't find a reliable and affordable childcare, so they left the labor force. But they're coming back as the childcare industry returns. And then also we had some baby boomers retire early because they thought, hey, look at my stock portfolio back in 2021 when stock prices were reaching record highs and inflation was still relatively low. They said, you know what, I can retire early and basically live out my next 30, 40 years with the money I've saved in the stock market. But what's happened since then? Stock prices are down almost 18, 19%, and inflation is up to 8, 9%. They may be reevaluating their early retirement and be coming back into the labor force. You want to get people back working again, you know, raise inflation and crush their stock portfolio, and they'll be back. And so hopefully we can get this back into balance going forward. Well, how is all this impacting credit unions? Notice the blue line I've just added to this chart. The blue line is credit union loan delinquency rate. And you can see it's around 0.42 today. That is the lowest in credit union history, the best of times. Kind of goes with that best of times labor market, right? Everybody's working, everybody's making their loan payment on time almost. Basically, I say that's really low. How can I say that's low? Well, let me add a new gold line here, but it's actually purple. My purple line is what we call the natural delinquency rate. And you can see that blue typically kind of hugs around that purple line. That's normal delinquency rate. You know, every $100 in loans, 75 cents are delinquent. Well, we're at 42 today, very low. Why? Well, we had all those stimulus checks, so people are still pretty liquid. Jobs are still there. The people can not losing their jobs. You know, layoffs are very rare. And basically, we also have there is a denominator effect in this data because loan growth right now is so strong. Since this is a delinquency rate, the denominator is just total loans, which are growing very quickly right now. And that's helped bringing this ratio down by increasing the loan denominator. But good news when it comes to this, but this will eventually drift back up to my purple line here in the next couple of years, but still remain relatively good. So what is our forecast now for the labor market moving forward for the next few years? Well, we're going to be about 3.6% average unemployment this year, trending up to 4% next year, and then by 2024 hitting around 4.5%, kind of where it should be. That's when the labor market will be back in balance. Remember, I said bringing down the demand for labor by raising interest rates, increasing the supply of labor as COVID goes away, and we'll be more in balance by 2024. But until then, we're going to have some issues. So for the next 2 years, the takeaways for credit unions with respect to this chart is, one, we're going to have a labor shortage for a while. We are going to have difficulty finding and recruiting and retaining employees, which leads to point number 2. Bargaining power has been shifting towards employees. They're asking for higher wages, better working conditions, more flexibility. They want to work from home or hybrid, remotely, all that stuff. And they've got the power to demand it because it's very hard to find replacements for them. Number 3, we are seeing a big increase in labor turnover, or what we call the churning of our frontline staff. I've seen some credit unions have a 50% churn rate in their frontline teller staff. And the quit rate in this country is the highest it's ever been. So a lot of people are quitting and finding a better job with a 20% pay raise elsewhere. What does this mean for credit unions? Well, number 4 is labor wages, of course, are going up 5-6%, but also training costs. I sit on the board of directors of the University of Wisconsin Credit Union. or UW Credit Union, as it's called. We're about a $5 billion credit union here in Madison. And during our last board meeting, we spent a lot of time talking about how our training costs were really going up as we have to train in all these new tellers and things. But that's going to lead into point number 5, is lower labor productivity. You know, you bring in somebody new who's the first day on the job, say after their training, they're not going to be as productive as, say, a 10-year veteran teller who knows how to answer every and all question a member may have with them. So productivity is going to drop, but that also means what? Is member satisfaction is going to drop. And if I got to wait on the phone 10 minutes to talk to somebody at the credit union, you know, your satisfaction is going to be hurt from that. So all of these are playing out in the labor market today. Let's move on to what I like to call, or let me just ask you a question. What is the most important price in any economy? You know, is it the price of oil, the price of gold, the price of the dollar? No, actually, it's the price of money. And that is what the Federal Reserve in Washington, D.C. is deciding right now as we speak. They're looking at all these same charts we're looking at. And basically, as we know, the price of money is just interest rates. And interest rates are important to us at credit unions because we are money traders, as we know. We buy and sell money. We take in deposits, pay one low interest rate, and then make a loan with that or sell the money at a higher interest rate. And then we buy low, sell high. Number one rule of finance, right? Buy low, sell high. Well, basically, we want to take a look at where interest rates may be headed. Well, my next chart here actually shows the Fed funds interest rate. As we know, the Fed funds rate is just the interest rate that banks lend money to each other overnight. So even though it's called the Fed funds, it is not borrowing from the Federal Reserve. It's just Bank A lending money to Bank B. But the Federal Reserve does control. Notice how kind of smooth this chart is compared to some of my previous charts. This is smooth because it's controlled by the Federal Open Market Committee in Washington, D.C. Well, where are we today? Right now, the Fed funds rate is at about 2.33%. Notice that's really close to my gold line. Remember, I said economists should have gold lines on their chart. 2.5% is neutral. We're at 2.33. Hey, that's close enough for government work. So basically, we're right at the gold line. Where has the Fed funds rate been the last 2 years? Well, notice it's been close to zero. You can see in 2020, 2021, the Fed kind of pressed their foot on the monetary accelerator to get this, say, economic car, if you will, going as fast as they can. Well, with the cars moving pretty quick, we have a little bit of inflation problem. So the Fed says, all right, it's time to take our foot off the gas and raise interest rates. And since March, this would be the fourth raise. Today would be the fourth raise since March. And that's brought us back up to the goal line, which kind of means the Fed has taken their foot off the monetary accelerator in the car, and then it's put it on the floorboard. So think of the foot right now of the Fed's on the floorboard of the car, not pressing on the gas, not hitting the brake. But by this afternoon, if the Fed raises at 75 basis points, we will be going above that gold line. That's like the Fed putting the foot on the brake finally to slow down the economy. But as we know, monetary policy, or raising interest rates, works with a lag, meaning it's really going to take 12 to 18 months for the full effect of this higher interest rates on the economy. How high do we expect rates to go? Well, basically, you can see here I put up a little purple text box. We expect the Fed to have rates over 3% by year end and probably around 3.5%. Think about December. They'll probably raise rates another 50 basis points in November, and then maybe another 25, 50 basis points in December. They've got 2 more meetings coming up, November, December, 50 maybe in November, maybe a 25 in December. We're going to be up, pretty close to 4% there, 3.5%, 4% by the end of the year. We expect the kind of the terminal or high level to be about 4% by the end of next year, 2023. That's where the Fed's pressing on the brake. They don't want to hit the brake too hard. You don't want to, stop the car or have a recession. But probably go up to about 4%. And then notice by the year 2025, 26, we're coming back down again. The Fed wants to be at 2.5. That's their Goldilocks level, if you will. That's why I kind of use the color gold. And by 2024, they'll probably bring it down about 2.5% again. So there's our forecast of what the Fed may do in the next couple of years. How does this impact credit unions? Well, of course, our deposit interest rates that we pay our members for the use of their money are basically set with the Fed. Notice the blue line on this chart is a 1-year CD rate. 1-year CD rate that credit unions pay their members. Look how closely that blue line tracks that gray area. So, if a member ever called up a credit union and said, hey, who sets the 1-year CD rate? They should really say, hey, Jerome Powell, the chairman of the Federal Reserve. The yellow line is our money market account rates. You see kind of how correlated they are with that gray Fed funds rate. And then the red line is just a regular share account, a savings account, if you will. And that's basically at 0 today and going to remain that way for quite a while. We don't expect that to be rising anytime soon. The second most important interest rate in the world after the Fed funds rate is the blue line on this chart. The blue line is the 10-year Treasury interest rate. And you can see where I have that 3.53% as of a few days ago. That's gone up quite a lot. I mean, just think at the beginning of the year, it was at 1.5. Today, 3.5. It's gone up a whole 2 percentage points. Basically, Wall Street, New York City, if you will, kind of gets ahead of what Washington, D.C. or the Federal Reserve is going to do. And so they've already pushed interest rates up quite a bit. Now, most credit unions don't buy 10-year Treasury notes. Too long-term, too much interest rate risk. The NCUA examiner would beat them up over the head if they started buying a lot of 10-year Treasuries. But it does impact credit unions with the 30-year mortgage rate. Notice that green line, which moves in tandem with the 10-year Treasury, is up to over 6% today. A 30-year mortgage at over 6%, very high. Notice there's a little bit of a gap between these two, however, because there's credit risk when you lend to a person to buy a house in the mortgage. They can default, and so we have to add on a little bit of a credit spread there, about 1.75 percentage points, because people get hit by a bus and they don't pay back the loan or whatever. But where is that credit spread today? What's the gap today? Notice it's around 2.5%. So it's got larger. Now, why is that? Well, basically, the Wall Street traders, they believe the Federal Reserve could start dumping their mortgage-backed securities. Over the last year, the Federal Reserve bought a lot of mortgage-backed securities, put them in their investment portfolio, but they're worried they're going to start selling them now. So go from buying to selling. And when you start selling something, of course, the price drops. And when prices drop, interest rates go up. The second most important rule of finance, bond prices down, interest rates up, and we see that going up here to a wider spread. All right, so interest rates are basically around 6% or higher. I thought it'd be interesting to ask the question, when was the last time in the United States we saw mortgage interest rates at 6%? Well, if you scan your eyes across the chart, you got to go all the way back to 2008 to see mortgage rates this high. So almost 14 years. So in other words, all those people who got a mortgage in the last 14 years got it at an interest rate lower than it is today. 14 years of mortgage originations. Not too many people want to refi right now because most of them have a loan rate lower than it is today. Unless, of course, maybe they got a subprime mortgage a few years ago because they had bad credit. Their credit's improved now and they want to refinance. But it's still, refi business has dried up significantly. And just to show that, basically we want to forecast here, where is the 10-year Treasury rate going to go? Well, notice where we kind of have it around 3.3 for the next few years. We really don't expect the 10-year Treasury to go much higher than it is today. The 10-year Treasury's kind of bounce around the 3.3, 3.5 range. We kind of think that this is its long-run equilibrium, kind of showing and balanced in the bond market for U.S. Treasuries. So don't expect the 10-year to go much higher in the next few years, which means don't expect mortgage interest rates to go much higher than where they're at. Like I said, they're around a little over 6% today. That's probably the high point for the next few years. Now, how does all this impact credit unions? All this interest rate talk and things like that. Well, notice this next chart. What is this next chart? It is the credit union, so just us, not banks, our first mortgage originations. What is the dollar amount of loans we grant each year? Notice those last two bars for 2020, 2021. They're both at around what? $300 billion of loans credit unions granted in the last 2 years. Almost double what we were doing before. Why has it been so strong the last 2 years? Well, I've added a yellow line to my chart. What's that yellow line? That's just the mortgage interest rate. Basic interest rates, notice that yellow line dipped to the lowest level ever in 2021. So when mortgage interest rates go down, mortgage originations go up. They move opposite directions, and we can see that clearly in the chart. But now we've seen interest rates go up. So notice the yellow line has spiked, like I said, about 5.5%, 6% today. What do we expect for mortgage originations at credit unions the next couple of years? Well, this year we're forecasting a 40% drop in originations. Next year, another 5% drop on top of the 40 this year. And then maybe by the year 2024, we'll see mortgage originations go up 10%. So basically, we are going to take a hit. This is a nice chart to kind of show how housing and mortgages are a very interest rate sensitive sector. We use that phrase, interest rate sensitive. Housing is the most interest rate sensitive because you're borrowing a lot of money to buy this asset, and it's a 30-year mortgage typically. So notice when the yellow goes up, the bars come right down, showing how the Federal Reserve and monetary policy is already impacting the economy. So rates have gone up significantly. And just to show you how it's also impacting, this is a chart on single-family housing starts. Now, what do I mean by this? Think of a home builder going out, buying some farmland, bringing in the backhoes and digging holes and then pouring concrete for a basement, putting up the wood, the studs, the roof, the windows. These are how many homes are being started each year in the country. The blue line is just the building permit. You got to get a permit to build a house. Notice what's happened in the last couple of months. You see that blue and yellow have dropped? They've dropped 20%. Once again, higher interest rates slow the economy down. And if you want one chart to show, hey, does higher interest rates really impact the economy? Yeah, right here. Take a look at this. It's down 20% already from building about 1.2 million homes down to 900,000 homes. A big drop of 20% already. I want to move on and talk about existing home sales because, of course, that's basically 90% of the market here. Here's a chart looking at existing home sales. How are we doing there? Let me put in a gold line. Like I said, economists have these gold lines on the chart. That's kind of where we should be, what's normal. Basically, 5 million is considered a good housing market. But notice that green on my chart, that's the existing home sales. Once again, not new, but existing homes. So you buying my house, I'm buying your house. Basically, the last couple of years, it's been strong. Look at that green's been way above the gold line, around 6.5 million for a while there. So why has it been so strong? Well, we had those low interest rates, so people jumped in, wanted to buy the home. We have a demographic phenomenon. What do I mean by that? It's called millennials. There's about 83 million millennials out there. Those are people ages 26 to 40. So 26 to 40-year-olds, what do you do when you're 26 to 40? Well, you're getting married, you're having kids, and you're buying a house. So also because of demographics has shot up. But notice what's happened in the last few months. We are now down to 4.8 million sales pace. So those higher interest rates have took us from around 6 million down to 4.8. So yeah, we are seeing monetary policy slowing the economy down, especially in housing. Notice I've added a blue line to my chart. What's that blue line? This is the whole story really in the housing market. The blue line is the number of homes for sale, or what we call the inventory of homes. Basically, we're down to 1.3 million. That is unbelievably low. We should be having about 3 million homes. If we had a normal housing market today, we'd have 3 million homes for sale, but we only have 1.3 million. Not too many people want to sell their house. Why? Well, basically, home prices have been rising strongly in the last few years, so nobody wants to sell an asset called a house that's going up 15, 20% in price. So everybody's holding on to it. But basically very low inventory. And I said the demand is still pretty strong. We're kind of right at that gold line because of all these millennials buying homes. So basically we're seeing prices go up. And right now, according to last year, home prices rose around 19% on average. I mean, that is an incredible number. That is the fastest in American history. So if you own a home, this is the best of times because you're seeing a 19%. Well, let's take a look at a chart giving the history of how fast home prices have been going up. And that's this chart right here. This is the OFEO House Price Index. Basically, OFEO is the government regulator for Fannie Mae and Freddie Mac. So these are the regulators for Fannie Mae, Freddie Mac. They calculate a home price index. And this is the 0.25% change. So looking at, say, the second quarter of this year compared to the second quarter of last year, how much of home prices going up? Notice my number there, 18.7%. What's normal for the US economy? No, notice my gold line, 4.1%. That's normal. So if you buy a home, if you have kids and they say, hey, mom and dad, should I buy a house? Say, yeah, home prices typically go up 4% a year, but now they're going up 18%. Clearly, that's not sustainable. It can't keep going up 18% because after a while, nobody's going to be able to afford a home. So clearly, this can't go on. But notice what happened in the past, the last time we kind of had this big jump. Remember back in the housing boom of 2005? For a while there, in one quarter, home prices had their peak of 10.7%. So I kind of put a little blue box there to highlight the fastest homes grew back in 2005. But then they fell for about 4 years. Notice in the middle of my chart, we had about 4 years there where home prices were in the negative territory. That's not good. And the worst they got was a minus 10% fall. So kind of a nice symmetry there, right? 10% up, 10% down. Where are we today? 18.7% up. So the big question on a lot of homeowners' minds, are we going to see an 18% negative number coming up soon here in the future? Well, let's just take a look at our forecast. I have a chart here looking at US home prices, what we forecast. This year, we're forecasting home prices to grow another 9%. Double my gold line there of 4%. So home prices are still going to be going up fast this year. Even though the Fed's raising rates and all that, there's still so much demand and very limited supply. Basic economics say you got a shortage situation, prices go up. Next year, however, we are forecasting home prices to slow down, not go negative, but slow to 4%. And then in those out years of 24 to 26, home prices growing still, but less than their normal 4%. So basically, we just pulled forward some of that future price increase into the last couple of years. So we don't expect home prices actually go negative like they did back and say, notice in the middle of my chart there, all those negative bars, pretty ugly for home prices. We don't expect that to happen. Why? Well, I'm going to use the 4 most dangerous words an economist can use. This time is different. Basically, back 8-10 years ago when we saw home prices crash, we had a surplus of housing. Too many homes. You remember some of those? I remember watching on the news in California say they were having bulldozers bulldozing down brand new homes that were built because they actually had such a huge surplus. That's not happening today. Today we have a legitimate shortage of homes. For the last 12 years, we haven't been building enough homes in this country. So we don't expect a home price crash. And basically here's just a chart. Point number 2, like if you focus on point number 2 on my list there, we do have a market imbalance in housing. We've been underinvesting in our housing stock since 2010. So 12 years, we have not been building enough homes to keep pace with population growth. All right. Population or household formation is about 1.2 million a year. We haven't been building 1.2 million new homes a year. So we have the shortage. Number 3 on my list, we have a lot better underwriting standards this cycle. With Dodd-Frank Act and a few other new rules and regulations, mortgage lenders today have to basically double check to make sure a potential borrower can actually pay back the loan. So no more of those liar loans we did back in 2004, 2005, and things like that. So a lot better underwriting standards. So no housing bust is expected this time. All right, that's housing. It is being affected by higher interest rates. But another major area credit unions do lending is, of course, with automobiles, car loans and SUV loans. Well, let's take a look at U.S. vehicle sales and how that's doing. First of all, where's my gold line? What should we be selling and making of cars? Well, we should be selling about 16.5 million cars. And notice my blue area is actual car sales. And for the last few years, it was kind of right at that 16.5 million. But then COVID hit. If you want to see the impact of COVID on the automobile market, look at that white V shape in the year 2020. There's COVID. That's like a punch to the gut, if you will, for the automobile industry. Sales just plummeted down to like 9 million. But then, the economy started reopening again. We didn't have those government mandated shutdowns anymore. And car sales bounced right back to that gold line. Because remember, think of that gold line as where the economy wants to be. And this is this small part of the economy, autos, but basically we bounced right back to that line. But then notice in the last year or so, we dropped again. we're only selling at what, 13.3 million is the current number. These are annualized numbers, even though this is monthly data. So this is like I think the July number. We didn't actually sell 13.3 million cars in July. That's been annualized. So what we did is took the monthly number and just multiplied by 12, because there's 12 months in a year, and that got us to that 13.3. So all these numbers are annualized numbers. But basically, we're below the gold line. And why is that? Well, we all know it's the semiconductor computer chip shortage. We need all these computer chips coming in from Taiwan and South Korea. They had some problems there, but they are kind of flowing now. So we are getting production back up. But as I mentioned earlier, you go to, say, a Cadillac dealership. In fact, I have a buddy here in Madison who owns the local Cadillac dealership. So I'm always bugging him as an economist. I'm asking him questions. Hey, what's going on with your dealership? And I asked him, if I bought a new Cadillac Escalade today with, my leather and my color and all that, so I ordered it, and they build them in Arlington, Texas. I go, how long would it take for me to get a new Cadillac? And he said, Steve, normally it takes 2 months. You go back to 2019 before COVID, you can get your car in about 2 months. He told me now it takes 12 months to get that new Cadillac Escalade. They're so backed up with back orders. So you got these dealers trying to rebuild their inventory. You have a lot of pent up demand now because people couldn't get their cars. So they got all these backed up orders at, say, the Cadillac manufacturing plant. So basically, car sales are weak. Now you would say, all right, if we're not selling that many cars, credit unions must not be making that many car loans. That kind of makes sense. But that's not the case. Basically, credit unions are booming in new car loans right now. Why? It's called pricing. We're basically pricing about 2 percentage points below banks. Our new auto loan rate says 3%, banks 5%. Clearly, you're going to go to a credit union and get your car loan. So we are stealing market share from banks, and we are seeing a boom right now in auto lending, which takes me to the next chart. Remember I said this is the Charles Dickens economy, but it's also the Charles Dickens credit union, the best of times, the worst of times. Look at that bar for 2022, the biggest bar on my chart. We're forecasting 13% loan growth this year, which would be the fastest in modern credit union history. So there's my best of times. Why is it up? Well, we're making a lot of, like I said, used auto loans because people have a hard time getting new cars. But we're also making a lot of new car loans because we're stealing market share from banks because we have lower interest rates. We're also making a lot of home equity loans because home prices have been rising so quickly the last few years. People are tapping into that equity and using their house like an ATM machine. But credit card lending is up because everybody's traveling this summer and they went out and bought airline tickets and hotels and restaurant meals and going to the theme parks or whatever. They spent a lot. So credit cards are booming, but also inflation. Everything just costs more. So if inflation's up 9%, so, that restaurant meal may cost 9% more, the airline tickets cost more, cars cost more. So just inflation, however, is also pushing up this bar to this highest level of 13. Now, I want to be clear here. I'm forecasting maybe 13%, but I may be a little bit underestimating what we could have. We may actually see 14 or 15% growth this year. Once again, because we got this added inflationary impact where everything just costs more. So, when you make a loan, you got the quantity effect and the price effect, right? Like how many cars are being purchased, but you also got to look at what's the price of the car. So you got the quantity effect and the price effect. We're making a lot of car loans because a lot of cars are being bought by our members, but it's also the price of the car is up. So that's also boosting our bar here. But notice in the out years here, we do expect those bars to drop. Next year, forecasting 8%, and then in the out years, only about 7%, which is right at my gold line. This is a nice chart to highlight the Federal Reserve's soft landing. They want the airplane to land softly on the tarmac. Well, notice how my bars are landing softly on my gold line. Think about that like an airplane landing. That's what the Fed wants. They want our lending to slow down because basically when you make a loan, you're creating money. People always say, hey, Steve, the Federal Reserve is increasing the money supply. And I say, no, the Fed does not increase the money supply. Who does? Banks and credit unions do. When you make a loan, when a credit union makes a new $50,000 Cadillac Escalade loan, say, they're making $50,000 in new money. When you look at the definition of our money supply, it is that new loans that are being made actually creates new money. So the Fed actually does. I mean, the Fed helps get the ball rolling, but they need banks and credit unions to make loans because that creates a greater money supply. And if we have less loan growth, that means the money supply growth is also going to slow down, which is what the Fed wants. And I've just got some talking points here. Like number one, this economic recovery after COVID is increasing our lending growth rate. More leisure spending this summer is really pushing up unsecured lending like credit cards. And then the last one, Federal Reserve. Members of the Fed's, we've got about 2 hours now, 2.5 hours before the Fed lets us know, 2:15 Eastern, 1:15 Central Time. Basically, those rising interest rates will weigh on our loan growth. It always does, and that's why the Fed raises interest rates, is to get us to slow down our lending. And just to kind of show you, I want to jump to this chart right here. This is look at the chart on the left. The left chart, that green chart, that shows credit union new auto loan growth. Notice how that bar, the green area, is literally spiked off my chart. It's at 28% annualized growth rate right now. I mean, that is incredible. I had to adjust my scale on this chart because it was literally off the charts. So credit union new auto loans are booming, which is great. Notice for a while there, because of that red bar, the recession there in 2020, it went negative because we were in that recession. Notice my next chart here, I've jumped to used auto loans. This purple area was at 21% growth in used autos. Once again, people couldn't find new cars, so they switched to used cars, and prices of used cars skyrocketed. So you had a big price effect there. But used auto lending is also booming, which is great. We need those loans, get the money out of the investment portfolio. The next chart here, credit union credit card balances. Let's see where that is. Reading off the chart, close to 16%. Once again, the fastest. My data goes, back to 1998. It's the fastest in, 23, 24 years. I'm doing the math right. So really strong credit card. How about home equity? Look at the spike here in home equity. Home equity is up about close to 24% on an annualized basis in the last couple of weeks here, or last couple of months. It's not the highest. If you look back on my chart, 2004 looks like we did see faster home equities, but they have recovered nicely from that little negative territory we saw back in 2020. Notice that red bar there for 2020. It didn't go negative, but it is back again and stronger than ever. Let's move on. What do we see in deposits? Well, we expect weak deposit growth this year. This is credit union savings growth. Notice for the year 2020, we have about a 5%. So deposits will be growing, but at a below trend. Notice my gold line, it's around 6.6. It's around that to 7%. Basically, we're going to be doing about 5% this year. So we are getting new members in. Membership growth is still strong at credit union, about 4% growth in members. So that's bringing in new money, but it's going to be weak. We started seeing back in April, May, and June, members pulling money out of their accounts. So the balances actually went negative. So even though they rise quickly in the spring because people get their tax refund and their bonuses, so usually the first quarter of the year is when most of our new money comes in, they started draining it down in the second quarter as they started spending again and traveling and doing all that fun stuff. So a little bit weaker growth this year, but notice by 25, 2026, deposit growth will come back up to its normal growth rate of around 6, 7%. But it is going to be weak this year. People are spending their money, and we're actually seeing it. We're tracking like interchange income, and every time they swipe their debit card, swipe their credit card, we make a few cents on that. And basically, they're spending, and we're seeing them draw down their deposits as they do that. One economic truism I like to throw at everybody, and this is my favorite. I teach economics at the University of Wisconsin in Madison here. I teach macroeconomics, I teach banking, and I try to throw this quote up every lecture. All right, and basically it's that economics is the study of the confusion between stocks and flows. Now, what do I mean by stocks and flows in this example? Well, stocks are your balance sheet. That's where we just kind of looked at loans and deposits. But the flows are your income statement. And right, if you want to analyze the financial condition of a bank or a credit union, look at their balance sheet, look at their income. One is the stock concept. The other is their flow concept. Well, we just got done kind of doing the balance sheet stuff, loans and deposits. Let's switch over to the flow part of economics, which is looking at income statements. How much income we're making per year, what were our expenses per month? You got to use that phrase, per month, per year, whatever. Well, let's take a look at the Charles Dickens quote again, the best of times, the worst of times. Well, here's my worst of times chart. Our yield on assets this year hit the lowest ever. Remember I said we're money traders. We buy low, we sell high. This is what we sell high at, but we're not really selling high. Notice in 2022, the first quarter of this year, we hit 2.92%. Translation, for every $100 that we sell, we only earn $2.92 on it. What was it back 20 years ago? Look all the way to the left of my chart. In the year 2000, we used to make $7.34. Now we're making $2.92, or we did in the first quarter. That's the lowest in credit union history. We've been around, what, over 100 years? I think the first credit union came in St. Mary's Credit Union somewhere in New England about 100 years ago. This is the lowest we've ever seen. Why is it so low? Well, notice the red line on my chart. You know, what's that red line? That's the 10-year Treasury interest rate. We talked about this earlier. We forecasted it earlier. Notice it hit the lowest ever in 2020. And there's a little bit of a lag. They hit a low in 2020. We hit our low about 2 years later in 2022. So basically the lowest ever. Why was it so low? Well, we weren't earning anything on our investment portfolio in the first quarter. Loan rates were still at historically low. Think of our auto loan rates, mortgage loan rates hit the lowest ever. So of course, we're not going to be making much on our loans and investments. The good news is going forward, I want to leave you with some good news, is that this is going up. We're already seeing going from the first to second quarter, the yield on assets went up about 20 basis points. Why? Well, what's the 2-year Treasury rate at today? It's around 4%. At the beginning of this year, it was less than 1%. So just investing money for 2 years at 4%, hey, that's actually better than a car loan. So I'd rather just buy an investment than actually put it into a car loan because there's no credit risk there. But basically, these interest rates have gone up nicely. Overnight deposits at the Fed, like I said, at 2.33 today with the Fed funds rate. That's going to be 3% probably by the end of the day. So our yield on assets is going to be rising quite significantly. And you can see my chart in those years, 2023 to 2025, moving back up to my gold line, which is kind of a long run average over the last 20 years for credit. So this is the worst of times chart right now, but things are going to get better. Also with that, of course, the worst times would be our net interest margin. If we are buyers and sellers of money, that net interest margin is the profitability of being a money trader. And notice where we were first quarter of this year, we hit 2.57, the lowest once again in credit union history. We're only making $2.57 for every $100 in assets that we take in deposits and make loans with it. You know, back in, once again, look at the year 2000 on the far left of my chart. We used to make way up there at around 3.8 almost, and now it's 2.57. But the good news is this is going to be going up also. Our yields on assets for most credit unions will be going up faster than our cost of funds. But deposit pricing is the hot issue right now at credit unions. How fast are we going to have to raise our rates to keep deposits in the credit union so they don't run off and go to some, say, a mutual fund or somewhere else? So deposit, for some credit unions with liquidity risk, which is the big issue right now for NCUA examiners. When they come to examine credit unions, they're always asking about, hey, what is your liquidity situation? What's your conditions for credit union, for deposit runoff and loan growth and everything like that. So liquidity is the big issue right now. And then we come to the bottom line. Here it is. Net income as a percent of average assets. That's my chart, or what we call the return on assets. Not to be confused with what we saw earlier, which was the yield on assets. This is the bottom line, the return on assets. The yield on assets is the top line. That's our revenues. This is the bottom line. Notice I have a kind of a goal line there of a ROA target of about 1%. Translation, earn $1 for every $100 in assets under management. Well, notice credit unions really haven't been hitting that in the last 15 years or so. We did hit it last year, 2021. We had kind of a special year, a lot of one-offs. We had really low provisions for loan losses. Also, we had really high gains on sales of mortgages because we were making all those mortgages through those low rates. But those have kind of gone away. You know, our provisions are going to start rising again, back to normal. Gains on sales of mortgages are dropping because we're not making many mortgages anymore. So what are we forecasting for the next few years? Well, notice we kind of use this phrase, the new normal. That 1% ROA was the old normal. The new normal is about 75 basis points. the average credit is going to be kind of settling in around 75 for the next few years. So it's going to be difficult to hit that 1% that we used to back in the 60s and the 70s and the 80s. So let's kind of summarize the big picture here. What is the economic update summary for 2023? Because I know a lot of credit unions are now going into their annual budget. They're also their 3 to 5 year strategic plan. So that's where I kind of went out as far as I could here for the 3 to 5 year planning. But basically, point number one, we are going to see a slowing economic growth for the next 2 years. Higher interest rates will slow the economy. Recession in Europe will slow the economy. And also what also just affecting the economy is just the supply side. We can't find enough workers. Remember, I said there's 11 million job openings out there. I mean, just think if we could fill all those jobs. I mean, let's say we just magically made 11 million people who are qualified, to work and put them in the factories. Well, our GDP would go up significantly. You had 11 million people to a factories. We'd make a lot more stuff, but we just can't find the workers. So the supply side is actually restraining the economy. We just can't get enough workers. So either we have to have more babies and have them grow up really quick, or we have to bring in more immigrants into this country, but that's got some political connotations with that. But basically, we just don't have enough workers right now. Number two on my list, falling inflation. So there's some good news. We're going to get this inflation down. We're not going to see deflation. It's not like prices are going to be falling, but they just won't be rising as fast. So we've kind of hit this new high price level, and the price level will keep going up, but at a slower pace. And that's what I mean by inflation dropping. Number three on my list, unemployment rate is going to be below normal. It's going to be a tight labor market. We're not going to be at the normal unemployment rate. So wages are going to keep going up. It's going to be hard to find workers and recruit and retain them. Number four on my list, long-term interest rates, kind of staying over that little over 3%. Like I said, they're around 3.5 today, 3.4, but we don't expect it to go much higher. And that means mortgage rates are not expected to go much higher than they currently are. Number five on my list, credit and loan growth will be slowing next year from this rapid pace this year due to a lot of pent-up demand, a lot of people spending, but also that inflation. Inflation will be slowing, and also just the quantity of stuff buying will also be slowing next year. Number six on my list, rising net interest margins. Some good news. We got to alleviate some good news here. Because of these rising interest rates, especially short-term rates, our loan rates are going up. The investment portfolio is going to be really happy. The CFO buying all those investments, they're going to be buying them at 4% for like a 2-year. That's some great interest rates that we could really use right now. And then the last one, the last talking point here is credit and mortgage originations dropping about 40 to 45% over the next 2 years. So what are we seeing? We're seeing a lot of credit unions reallocating their staffing, taking people out of the mortgage department. We don't need all those loan officers and mortgage anymore. And we're reallocating them to consumer lending, auto lending, credit cards, things like that. So we are reallocating staff around. We're still looking for more staff, trying to hire. We're seeing a lot of churning taking place. But basically, mortgage is going to be down for the next couple of years. Well, anyways, that's my forecast. That's my guesses for the next couple of years. At this time, we'll take any questions that you may have.
We had one question that came through the chat, Steve. It said, you mentioned job growth correlating with recession. Are the stats misleading? Do those who are no longer eligible for unemployment benefits but still are unemployed show up in the data?
Yes. Just because, say, you're unemployment, or usually unemployment, you can claim unemployment insurance benefits for like up to 26 weeks. Even though they run out and say, I've been unemployed for 26 weeks, I'm now in my 40th week of unemployment, you are still considered unemployed. So they're completely different. There's unemployment insurance, mainly dealt with the states. But when the Bureau of Labor Statistics does their survey of the country, yeah, your benefits can be expired, but if you're still unemployed, you are in the number that I mentioned earlier. Remember I said there's about 5 million unemployed people? You're still in that number. You're still considered unemployed. But of course, you have to be actively looking for a job. To be considered unemployed, you have to be, one, you don't have a job, but two, you've had to look for a job in the last 4 weeks, meaning you've sent out job applications, you've gone on job interviews. If you haven't done any of that, you're just sitting at home watching TV, you're not unemployed, even if you don't have a job. You got to be actively looking. So, but no, the whole thing with unemployment insurance doesn't matter.
All right. Another question that came in was, are we able to share the slides with the audience today?
Yes, I've sent out the slides here, and you can use them however you want. I did send it out as a PowerPoint, so you can actually take the PowerPoint, download it, use it at your next board meeting, put in new data, and update the charts going forward for the next few years if you like. But yeah, there's no proprietary data in here. This is just all public data, so you can use it however you like.
Perfect. Another one that just came in. Can Rick comment on his forecasts for rising net interest margins with his expectation, oh, sorry, someone just put a message in below that, of declining mortgage originations and loan growth?
Yeah, with things with mortgages, actually, with the interest rate on mortgages up to around 6, some credit unions are over 6.3, 6.4%. More and more credit unions are making the decision, you know what? These mortgage rates are kind of actually all right. They're pretty decent. And a lot of credit unions would originate these mortgages and then sell them off to, say, Fannie Mae and Freddie Mac. For example, UW Credit Union, the one I'm chairman of the board of, we sold off almost all of our 30-year mortgages. But we're starting to reevaluate that. Say, wait a minute, if we can book a loan at 6.5%, we may just be keeping that on our books, which will help bring up our yield on assets, which will help bring up our net interest margin. So instead of selling everything off to Fannie Mae and just buying, short-term investments, if you have excess liquidity, let's put a little bit excess liquidity into these mortgages, especially hopefully if rates don't go up even higher, which brings in the whole interest rate risk scenario. But a lot of creditors are saying, these are decent rates for a mortgage. So that's really going to help our net interest margin. Instead of booking a 3% mortgage like we did in January, we're now booking 6.5% mortgages here in September.
Can you talk a bit more on housing? Housing stats are down and the demand for housing remains strong with demand exceeding supply. How does this impact housing prices in the next 2 to 4 years?
Yeah, remember, I did have my chart on where my forecast for home prices. We're forecasting, once again, home prices are going up 9% this year. So still double the normal home appreciation of 4%. Because of that strong demand, those millennials I spoke about, and not too many people are still selling their homes. Next year, we're forecasting 4% increase in home prices, which is just normal. Home prices normally grow 4%. We expect it to be 4% next year. But then in those out years, home prices are only growing about 1 or 2% below the normal 4%. So like I said, we kind of pulled forward price appreciation that we would have experienced in, say, in the year 2024, 2025. We got that. We've already got that. So it is going to start. Like I said, we don't expect a big drop in prices like we experienced 14 years ago with the housing boom and bust. You remember, think of 2007, 2008, 2009, home prices came crashing down because we did have a surplus back then. The market has changed today. We have that shortage today. And whenever you have a shortage of something, prices remain strong.
Next question. When you say mortgage originations will be falling by 40 to 45%, what do you mean?
The actual dollar amount of mortgages granted. So now looking at the balances, just the dollar amount of loans granted will be falling by 45%. So instead of 300 billion like we did, the last couple of years, it's going to drop 40%. So the actual dollar value of mortgage loans granted will drop. So I'm now looking at the balance of the loans on your portfolio, but our mortgage granted or mortgage originations.
And just a follow-up to that. So the drop in originations, is that for 2021 levels, like year over year?
Yes. Yeah.
Okay.
Take what we had for 2021 and do the percent change down 40% from that level. Okay.
Next question. Do you have any thoughts or comments on recent ALM and interest rate risk results?
Yeah, well, the big, of course, the one is because these interest rates have gone up, the value of our existing investment portfolios has dropped. And of course, if you have labeled them available for sale, we've taken a big hit on our capital asset ratio. I know, once again, using anecdotal data at the credit union I'm with, we saw a drop in our capital ratio as we've had to market those available for sales portfolio. And so, of course, you don't want to sell them now because they're underwater, their price is less than the original face value. So that is affecting the liquidity situation because I said, deposits may be running off or not growing as fast, but loan growth is strong. So how do you fund that? Where we're seeing credit unions having to sell investments and basically run down the investment portfolio. But you really don't want to sell the investments that are underwater because you've already had to hit to your capital to asset ratio because you had to bring down the mark to market of the bonds. So right there, one thing about economics, we always say that when interest rates do go up, what gets hit first is the balance sheet. Like I said, we're already marking to market the investment portfolio, bringing down the capital asset ratio. All of that is balance sheet stuff. In the next few months, we'll switch over to interest rate risk impacting the income statement, the actual flows. Are we going to be paying a lot more for our deposits going forward? So it really has to depend, it really depends on the loyalty of your members. Can you get by with raising your deposit rates slower than the market? Or are your members maybe not that loyal and they'll just pull their money out and go to the nearest, other bank or money market mutual fund paying a higher rate? So, I always kind of say that going forward here, loyalty is going to make a big issue to your income. Think about the loyalty of your members with respect to the deposit rates. If they'll, grant you to go slow and lag the market and not raise as fast. So, if you can, that's going to help out your bottom line. But also the loyalty of your employees. Will your employees stick with you if you're only giving them a 3 or 4% raise? Are they really happy working with your institution and say, yeah, I know inflation's at 8% and you should be giving me a bigger raise, but I'll accept a 4% raise because you gave me good raises in the past. So hopefully, if you got loyal employees, maybe you can get by with only a 3-4% raise this year. If you don't got loyal employees and they're just going to, leave if you don't give them a 6% raise, then you have issues. Then your operating expenses are going to jump because of the labor costs going up. So I kind of say it's all about loyalty right now. Do you got loyal members for your interest cost, or do you have loyal employees for your labor cost? And both of those feed into your bottom line.
All right, next question. The month-over-month inflation rate was 0.1%. That does not seem unreasonable, despite the year-over-year still being high. Why did this create such a large reaction?
Yeah, I mean, we are seeing, like I said, you mentioned the numbers perfectly and accurately. Basically, using year-over-year numbers can be a little deceptive when you're looking at what's happening now, what's happening recently. And really, why we're seeing that month-over-month number being relatively low is because gas prices have really come down. Gas prices are about a 4% chunk of our total spending. And because gas prices have dropped significantly, that's kind of brought down the average to only about a 0.1. Even though food prices are still going up, rents are going up, medical care costs are going up, that gas prices kind of help bring that down. And so, yeah, right now, inflation is getting better. But when you compare it to a year ago, when we did have a huge run up, it is a little deceptive to compare year over year because you really want to look at what's happening in the last few months. But like I said, the big one is just gas prices going down, pulling down that overall average number. But like I said, we do expect, we are starting to see turnarounds, and like lumber prices are down, corn prices are down, oil prices are way down. And so we are starting to see some commodity prices come back down, which is really good news. And of course, if the war in the Ukraine got over, hopefully sooner than later, that'll also help bring down inflation, bringing down more commodity prices.
Great. Next question. When do you expect a normalized yield curve?
Oh, well, basically, remember I said we're forecasting the short-term rates to come back down in 2024, 2025. So that's 2.5 years from now. So it's going to take a while. We got to get the short-term rates back down to somewhat normal because they are going to go up. I mean, the Treasury market is forecasting the Fed's going up to 4%. That's why that 2-year Treasury is at 4%. Because one thing about economics, like I said, I teach the banking class at UW, and in my banking textbook, there's something called the expectations theory of interest rates. Expectations theory of interest rates, which basically says like the 2-year interest rate is just what the market expects the Fed to have the Fed funds rate for the next 2 years. And so that's why the 2 years at 4%, because they expect the Fed to have short-term rates at 4% roughly for the next 2 years. So yeah, it's going to take a while for the short-term rates to come back down and have higher long-term rates and short-term rates. Because right now we've got this inverted yield curve. It looks kind of weird. The 2-year Treasury is at 4, where the 10-year is at 3.5. But this kind of shows the market expect the Fed is going to lower that interest rate in the future. That's why the 10-year is lower than the 2-year, because they do expect the Fed to raise rates in the short term and then bring them down again in the long term.
It looks like that is all of our questions. We'll give it a few more minutes. If anyone else has questions, please put them in the chat. We'll have Steve hang on for another few minutes. We got a thank you, Steve. But it looks like we're wrapped up with all of the questions. Any closing words, Steve?
Like I said, the big story next year is going to be that labor. The big story this year has been inflation, and that's, of course, the goods and services market. The big story next year is going to be the labor market and what we call the labor paradox. Just to quickly, what is this paradox we're seeing? You know, we hear some economists say we could be in a recession. We hear some CEOs say they're expecting a recession, but that they're not acting like that. If they thought a recession was coming, they would stop hiring, the job openings would start to drop, we'd maybe even see layoffs, but we're not seeing that. We're seeing them act completely different. They just want to keep hiring and hiring and hiring, and that's not something you typically do in a recession. So economists are kind of studying this labor paradox. Where will labor market be next year? And are wages still going to be going up 5-6% this time next year?
Great. I think that's everything. Thank you so much, Steve, for sharing your insight with the group today. Hopefully we can have you back next year at this time, and we'll be singing a different song to this, and hopefully we'll see a better economy. Thank you again. I will make sure everyone gets a copy of the presentation, and this is recorded, so it will be housed on our website. Thanks again, everyone, and have a great afternoon.